Good morning, everyone. Welcome and thank you for joining us today. My name is Eric. I'm the account manager at Connecting Up in TechSoup New Zealand, and we're part of the Info Exchange Group, a not-for-profit social enterprise that tackles the biggest social challenges by the creative use of technology. For those of you that haven't attended a webinar session with us before, Connecting Up in TechSoup New Zealand facilitate a training calendar of online webinars, workshops, boot camps, and webcons to help the social sector upskill in all digital areas, and you can check out more on the training section on our websites. Today, I'm really excited to welcome you to join today's webinar, which is KPIs and Metrics for Not-for-Profits, which is being presented by Mick Devine, the CEO of CalCSA Australia. Mick is a CPA and he's been involved in accounting systems for not-for-profits since before the implementation of GST in Australia, and has spent most of the past 20 years designing and developing tools to take time out of the budgeting and reporting process. His award-winning CalCSA application is also available through Connecting Up in TechSoup New Zealand, and again, you can check that out on the website. Now, before we begin, just a little bit of housekeeping for myself. All the lines are going to be muted today, so if you've got any technical issues, just type that into the questions box and I'll do my best to assist you throughout the webinar as that's running. If you've got any questions during the session, we'll be doing a Q&A section at the end of the webinar, so don't hesitate, don't be shy, there's no silly questions. If you've got any questions for Mick, go ahead, type that into the questions box. I'll see those as they come through, and again, we'll run through those at the end of the webinar for you. We do really encourage you to ask questions. We love it when these sessions are interactive. So again, don't be shy, ask away. Now, a little bit different on this webinar is you may notice on your GoToWebinar panel that there's a handout for you, which is KPIs for NFPs, which is a PDF sample document. You can go ahead and download that through the handout section, but if for whatever reason you don't get to that, that's okay. I will be sending out a copy when I send out a copy of the recording and the slides for you tomorrow. So again, you can check out that handout section. You should be able to download that little workbook, but if you can't get to it now, don't fuss, I'll send it out later. Now, if you're on a Wi-Fi connection and you've got multiple programs open, that can sometimes affect the quality of the audio and video, so go ahead and close those down if you can. We just want you to have the best experience that you can today. As I made mention for this webinar is being recorded, so we will be sending out a copy of the recording and the slides. Don't fuss. If you want to go back and check anything later, you will be able to. I should be sending that out either tomorrow morning or on Monday morning, so keep your eyes peeled for that. Finally, there's going to be a little bit of a short survey at the end of the webinar. We'd love it if you could share some feedback with us. So yeah, if you could take a minute of your time at the end to do that, that'd be awesome. Otherwise, that is it for me for now, so I'll hand it over to Mick. Thanks.
Thanks, Eric, and good morning, everybody, or good afternoon for those of you in New Zealand, and who knows what time of the day those of you watching the recording. So welcome. What we're going to do today is talk a little bit about KPIs, why we do them, and then some examples. I'll talk a little bit about spreadsheets and doing KPIs in spreadsheet. Most of my examples I do using the CalCSA app, but that's just because that's a convenient way of doing it. You know, these are all, you know, relatively simple KPIs that you could produce in a spreadsheet. It's not rocket science. And I think the whole point of KPIs is about giving you shortcuts to information. It's trying to give you some simple numbers so that you don't have to wade through lots of detail to see whether things are working or not working. And sometimes it's the relationship between things that are important. You know, sometimes you want to know, you know, what's my income like? What's my expenses like? How's my net profit surplus going? How much money have I got in the bank? But other times it is about those relationships. You know, how much are my wages compared to my income? And that enables me to measure my performance against previous periods when my income may have been different. You know, because if my income's 100,000 last year and my wages were 70,000, this year my income's 200,000, my wages are 100,000. Is that a good or bad figure for wages? without those comparisons, you don't know. So, wages have gone up, but the revenue has gone up further. So as a proportion of what we're receiving, we're getting more value out of what we're spending on wages. So sometimes those comparison ratios are what can really make a difference in understanding the changes that are happening in a business. And I guess that comes to the next point of KPIs, is that they don't necessarily make sense on their own. And if we stick to that wages to revenue example for a moment, if I come along to an organization that I've never met before and I say to the finance manager, what are your wages as a percentage of revenue? And she says to me 75%. On its own, I have no idea whether that's good or bad. I have no idea whether it's better or worse than anything else. But if I know that another organization down the road that is in a similar field to this one has a wages to revenue KPI of 70%, I might be able to have a discussion with her and say, yours is higher than the person down the road. Is that because you're doing something different? Is it because you're providing better service, or you're being more efficient with your other resources, so you've got more resources to spend on wages? And then the other thing is, was it 75% last month, last year, last week? And often I find with KPIs, it's those trends over time that tell you whether things are good or bad, rather than the raw numbers. So I think one is a benchmark against your peers, other organization in similar circumstances to you. Are you doing things better or worse than they are? And with these KPIs, it's never always just what's good, what's bad. It's not necessarily a black and white. It's why is our ratio higher than everybody else? And because we do things differently, we provide a more personalized service, and that's a really important part of our goal. Therefore, we expect to have a higher wages to revenue ratio than everybody else, because they're focused on providing the leanest, most efficient delivery of service, whereas we maybe are providing something that we think is a better quality service to our clients. Therefore, we accept that part of the cost of that is having a higher wages to revenue ratio. So my first words of advice are to be cautious in interpreting KPIs, and be cautious about thinking of them as something black and white and rigid. Sometimes there are external benchmarks that may be useful to you. Knowing what everybody else in the industry is doing can help you work towards doing things better, doing things more efficiently, questioning how you're doing things, why you're doing things, and that can help in ways that just looking at a standard income, expenses, or even a balance sheet can do. So those are the reasons why we look at KPIs. And in terms of board reporting and management reporting, they can be a very concise way of presenting a message. And because they're often a single figure or a pair of figures, they're easily transposed onto a chart, which means you can provide visual information, which is great for non-accountants. You know, I have been a CPA for 30 something years. I know it's more than 30 because they gave me a watch last year, but you know, so the accountants amongst us, we can look at a balance sheet, we can look at a profit and loss report and learn something from what's happening there. But if you've got board members who don't have that experience, don't have that education, having a page full of numbers isn't always so easy. So KPIs are a really good way to present financial information in ways that are understandable to non-accountants. They're not necessarily the whole of your report. You know, there are times when those numbers are important, but they're a great addition to any senior management or board reports. And, you know, even in my organization here, when we do our monthly management meeting, a big part of it is looking at KPI reports. And ours would be slightly different to most of yours, but that again, I think, is one of the strengths of KPIs. It's choosing the ones that are relevant to your organization, and the KPIs that are most important to you will vary over time. It's about what are the most important problems that you're trying to resolve at the moment, and KPIs give you a way of highlighting that. It might be that, you know, your cash reserves are low, and the board has set a strategic objective to increase cash reserves over the next 5 years or 2 years or whatever. And therefore, measuring those cash reserves either as a raw number or as the number of days that you could last on those reserves is something that's important to measure. There'll be, you know, at the end of that 2-year, 5-year period when there's ample reserves, you might not need to look at that every month, and there'll be other issues that are more important and other things that you want to improve. So it's about what are the key bits of information that you're working on, and very much I would build this into, I guess there's a strategic element to KPIs, especially at the senior management, the board level, and they're a good way of communicating those KPIs and that strategy to other areas of the business as well. You know, if the KPI is to be more efficient with our team, and we're measuring that as, you know, wages as a percentage of revenue, that is something that every team, every program, every department can monitor and contribute towards, and show their efficiency and their contribution to the efficiency of the overall organization. So there are different uses for KPIs at different times in your organization's life cycle. So I'm going to show you some examples of a few different types of KPIs today, and I've divided them up into financial, so the ones that are to do with the financial performance of the organization, some operational ones, how efficiently are we doing things, how well are we doing things, cash flow, because that's particularly important to board members. I'll talk a little bit about spreadsheets and just a few general tips on spreadsheets and how I would set up a spreadsheet for producing KPIs. And then most of my examples, just because it was easier for me to put them together and I'm efficient, I'm not lazy. I've done them in Calxa. But as I said, you don't need a fancy app to do these KPIs. That's not the purpose. It's just a way of giving you examples. So you know, KPIs can give you that strategic planning stuff and help you measure your objectives. There's the governance, the compliance aspect. You know, are we doing the things we said we'd do? Are we achieving what we said we'd achieve? And then accountability. And that becomes especially at the sort of departmental team level. You've delegated some responsibility to somebody. A KPI is a good way of measuring that. I mean, again, word of caution there. Yeah, the danger with KPIs for accountability is that you steer people towards just achieving that KPI regardless of the side effects of that. You know, if you had a KPI that was, you know, we're going to reduce our wages to revenue percentage from 75% to 70%, somebody focused solely on that could damage your relationship with your employees by cutting their hours, not giving them the salaries that they need, so you potentially build up problems there, or cut services to clients, so the clients don't get the services that they should and the standards that they should, because that KPI doesn't say anything about those standards. It doesn't say anything about how we treat our teams. So, as I said, you have to treat KPIs carefully. They can motivate people in the wrong way if they're applied too rigidly. And, you know, if I have that KPI for my department that says we want to reduce the wages to revenue from 75% to 70%, then it needs to be within the context of keeping the team happy so that they'll stay for a long time. It means in the context of maintaining the same level of service to customers. So then the way to achieve it is to help more customers with the same team to be more efficient in providing that high level of service to our customers, and to reduce our costs in ways that doesn't impact the customer and in ways that doesn't impact the morale of the team around. So it's not just numbers, and that's all. Yeah, that's what I want to say there. And then on the funding side of things, lots of funders, grant providers, even on the, you know, those of you funded by donations, donors often want to understand some of the KPIs of an organization. One that raises its head in public from time to time is, the percentage of funds that are spent on admin, as though, you could run an organization without admin expenses. But sometimes you need to provide that information to people. So for transparency purposes, you might provide explanations with it, but you'd still need to do it. Quick discussion on spreadsheets, because I know apparently many people use spreadsheets for their financial reporting. And pretty much every accounting system I've ever come across has a method of exporting data to Excel, whether you're using MYOB or Xero or NetSuite or SAP, they all export data to Excel. And if your budgets are in Excel, you then need some sort of VLOOKUP system or something to match the budgets against the exports. So I'm not going to go into the detail of that, but what I would say is that there's some, I used to think I was very clever with spreadsheets, and back in my younger days, I did many things with spreadsheets, and what I discovered was that when I passed them on to somebody else, no matter how clever I thought I was creating this spreadsheet, they inevitably ended up scrapping it and creating their own because they couldn't follow mine. And I don't use spreadsheets anywhere near as much these days, but I did learn over time that, there are rules, and the main rules I think with spreadsheets are about separating things. I put a cover page on all my spreadsheets where I have a title, I put when I created it, when I last modified it, and I update the version number every time I modify it. And on some of them, I'll put some notes on that sheet of what I've modified each time so that I can come back later and I know what I've changed. This one's a simple example. I've just got 2 pages, but especially if I had 6, 8, 10 pages, I would always have a content page with a link to each of the other pages, and you can create those links to just jump to another tab in Excel. And then my raw data page, I would keep separate from the outcomes, and I would, if there's regular formulas here that should never change, or intermediate formulas, I might put them on this page. But then here is the output, which is going to look up whatever is on that assumptions page, and this is where I would print my output. And yes, you can make it look pretty and all that sort of thing, but I think it's the key thing with spreadsheets, whether it's KPIs or anything else, is separate that information. And so let's put that to a side for a moment and let's go and look at some KPIs. So some of the operational ones, and these will depend on what sort of organization you are. And the first couple I've got here are membership related. So how many members do we have? The churn in members, so how many do we lose? So which is a good way of, so the first one, the number of members, tells you how good you are at attracting members. The membership churn, which is the number you've lost compared to the number you had, tells you how well you're keeping them. Are you looking after them? Do people want to stay with your club, whatever it is? So those are things to look at. And then the other operational ones there, which are more general, are a couple that I mentioned earlier: wages compared to income, admin compared to income. And if I look at, if I just quickly show you, if I've got, let me bring my other screen over. Just to show you, with membership, at some point, you need to record how many members you've got. And if I change my layout there, no, sorry, wrong one. I want metrics. So membership's obviously not something that's coming out of the accounting system. It's non-financial information. And what I'm doing here is I've got a metric here for current members, where we have a budget for the number of members that we expect to have at the end of each month. And then each month I update that with the actuals, yeah, so that we record how many members we've got, and then we do a chart comparing actuals against budget. And then we also do lost members, so how many members have we lost each month? How many resigned, didn't renew their subscriptions, that sort of thing. So then in my KPIs, I can do members. So if I look at my current members KPI, so in this case, it's a simple KPI. It's just picking up the total number of current members. And just to show how I create that in Calc, so I just start typing current members, and then I get that. And the churn is lost members divided by current members. So on the sample PDF that I've attached, there is, I've put all the formulas that I've used in my examples. If I just find my, and I might just show you those examples as we go through. If I can get this on the right screen for you. So in this case, I've just done a simple chart, and I think this is one of the good things about KPIs. I've just done a simple chart comparing actuals against budget. And I was going to say for the last 12 months, I've actually done the last 13 months. So in this case, I'm looking at October, and I'm comparing it to October last year and all the trends in between. And obviously our membership goes up and down in this organization. And the churn, we have a budget of 2%, and we started off with fairly high churn. We've done some work with our members to try and keep them. We did very well in getting closer and closer to the budget last summer. Things went astray in April, May, June, improved again in July, and steadying out somewhere fairly close to the budget now. So you see, that tells a story, and you don't need to be a rocket scientist to understand it. I can look at that as a board member, as a department manager, as a anybody, and say, yep, we've started off not doing terribly well compared to our budget. We have improved. We've had a couple of blips, but now we're steadying things and we're much closer to the budget. So those are the things that I think make KPIs useful. It's about telling that story, communicating to people. And similarly, if we just look at my admin to revenue, if I look at how I've created that KPI, I've just got admin divided by total income plus total other income. And they're just groups of accounts. And you'll see here, admin, I've just said that includes these specific. So this is my expenses out of my accounting system. And I've said these ones here are the ones that I count as admin costs. So that's what I want to use. And similarly for wages, you know, in this case, I'm including annual leave and recruitment expense and that sort of thing. And if I just bring that one across again, I can do a report. And in this case, I've done it by department, so we can see each department. And, you know, so admin to revenue, I've got a couple around 11%. Overheads, it's 89%, which maybe makes sense because my overhead department is almost wholly concerned with admin, and it also probably doesn't get a lot of external revenue. And then my other departments, some are spending 5%, 9, 1, 13, but I can see, you know, that variability as a manager will maybe allow me to ask questions about, you know, why is this department got high admin expenses? Why is the other one different? And it's about understanding that. And, you know, there's quite possibly good reasons for that. You know, it's maybe because, you know, this one has a lot of funding that doesn't need much administration. It's performing programs that don't need much administration, but maybe this one here requires a bit more admin and support staff in order to make the operational people effective. So it's not just saying, you know, this one's good, this one's bad. It's about understanding what's happening in your organization and the nature of the teams that you're working with. And similarly with wages as a percentage of turnover, there may be some parts of your organization, you know, if I had a fundraising arm, for example, you know, a fundraising department, maybe 36% of revenue is good in that case, because they're, you know, for every person that I've got working there, they're bringing in 3 times as much revenue as what they're costing the organization, which means we've then got funds for other areas. Whereas the service delivery teams may well be at 75% of wages compared to revenue. So I think the thing to avoid is labeling one KPI as good or bad. It's about understanding, using them to understand the nature of the different departments in your organization and what's good or bad for them. You know, this 75%, I'm saying that, you know, in a service delivery department may make perfect sense. But if it was 60% last month and the month before, I would be asking why it's 75% now. On the other hand, your fundraising department, you know, if it's 36% now, and then I go and hire another marketing person in that team, it may jump up to 50% for a few months until they find their feet and become effective and start raising funds, in which case it then drops down to 36% again. And it's about monitoring that over time and understanding why things are changing, why it's varying, and using that information to manage the business better. You know, that example of, you know, I hire another marketing person and it goes to 50%. If it's still at 50% in 12 months' time, I would be questioning what the value of adding that person in was. You know, are they not effective? You know, and at what point do we expect that ratio to drop down? You know, we hire a new person, we know the ratio goes up. At what point do we expect them to be delivering new funds, getting new donors, and therefore reducing the ratio? It's about helping you to manage that sort of decision making. So if we just have a look at some more examples. So some of the financial side of things is some of it's, you know, fairly standard accounting stuff. You know, average debtor days. You know, there'll be some of you, I'm sure, who've worked for organizations that never sends out an invoice at all. There'll be others, you know, because you're grant funded, or, you know, you send an invoice to the government department twice a year to get your grant and they pay it straight away. There'll be others of you, especially in some of the consumer directed care, you know, aged care, NDIS, where you'll either be invoicing a central authority like NDIA, or you may be providing some services direct to clients and participants where you invoice them direct. How well are you collecting that money? You know, it's not something that some not-for-profit organizations have had a habit of doing. It's something they've needed to learn to do over the last few years. So that's one area. Self-created, self-generated funds. One of the, you know, I know one of the big movements over the last few years has been for not-for-profit organizations to try and become less dependent on direct government funding, on grant funding, because it is at the whim of changing fashions. You know, you might get your grant funding for 3 years, but then you don't know if it's going to get renewed. You don't know if there's going to be a change of government. Your particular area isn't so important to the new people coming in. They cut your funding or you lose the funding altogether. So grant funding is insecure in that sense. It can be secure in the short term of, you know, that 2 to 3 year funding program, but some funds are only 1 year or 6 months even. So a lot of organizations have looked to other sources, either through donations, through philanthropy, through can they provide other services like, you know, the direct services that they might be providing to their NDIS clients? Can they provide those at a professional fee rate to other people, and that sort of thing? So if that's a goal of your organization, then measuring the performance of those funds as a percentage of total funds is important. Unit costs is about understanding the costs of the services that you provide. And again, if you're in that sort of aged care, disability care sector where you are providing services, and especially something like the NDIS, where there are either fixed prices or ceilings on prices, if there's a price that you can sell that service for, you need to understand what the cost of that service is. So you need to look at the total cost that you've spent divided by the number of services you provided to find the cost of each one, so that you know that either your cost is below the price that you're recovering, or if it's not, then you have some plan for cross-subsidization from elsewhere in the organization. But if you don't understand that cost per unit and the loss or profit you're making per unit, you won't be able to make those decisions and manage those funds well. And then net equity, how much money does this entity actually have? You know, what assets do you have? What liabilities do you have? Because that will tell you a story about the long-term sustainability of your organization. So if we just look at a couple of examples of those. And so this is the debtor days one. So it's the average time it takes my customers to pay me. And I had so last year, on average, it was 18 days, and it crept up slowly to 20, and then it stayed at 20 for a long time. But the last few months, it's started to creep up at a much quicker rate. If I was a board member looking at this report, I would be saying, what's happening in our finance department? Why are we not collecting our outstanding invoices? Is this something that's changed in our systems, in our personnel, or is it the result of something external in the economy where our customers are struggling for cash, they're struggling to pay us? Do we need to look at payment arrangements for them? Do we need to look at different systems? I don't know what the answers are, but seeing this would prompt questions. Yeah. So, and that is ultimately what will help change things in the organization. Similarly, the self-generated funds. I mean, I've got some dodgy numbers here that are going up and down, but you know, we start off with our budget under 10%. We decided it should go up to 25%, and then we expect a dip in July because maybe donations are historically low in July, but then we want to get up around 30% or so from there on. And then how have we compared to that? It looks like we did pretty well in the first few months, pretty much on budget for a while after that. July turned out to be absolutely zero rather than just a drop. And then we've recovered better than that mostly. So again, it's about presenting that information, showing what's happening, and I will show you the formulas for that in a minute. And bed night costs. So this is a unit cost example. Organization providing accommodation to people, and so a bed night in this context is one person in one bed. We count up how many of them we have over the month, divide our total costs by the number of beds occupied, and that tells us the average cost per bed. And and maybe there is some benchmark that is what the NDIA will pay us. Maybe it's a benchmark that's the average of all the other organizations in this area. But by comparing yourself to this benchmark, you can look at that and say, okay, we've had problems, we started improving things, but things have gone off track again since. So it's about monitoring that, managing that information. If I just show you where, oops, sorry, I'll just bring the right screen across for you. So with that benchmark information, if we look at that one first, so my KPI for that is, so I have one KPI for the benchmark costs, and I've just got a metric that's just looking up that amount. And then the costs are my total accommodation costs divided by my occupied bed nights. And excuse me, so the accommodation costs has come from my accounting system. So in my account groups here, I've just defined accommodation costs as being these particular costs, and maybe I'm just running this for one department where I'm looking at all the costs for that department. Depends on how your accounts are set up. And then again, I would have some non-financial metrics where I'm just recording the benchmark costs. In this case, I've just got $50 as the amount each month, and then I put my occupancy figures there of how many beds are occupied each night, each month, depending on how you're measuring this, and then you can calculate the average. The debtor days, if I go back to my reports and KPIs, so something like debtor days is my trade debtors balance divided by my average income that gets invoiced times 365. So as I said, these are in the handout, so you'll see them there, and whether you create them in something like Calcsa or spreadsheet is same result. Yeah, you know, my self-generated funds, I've just got an account group that says these are the self-generated funds as a percentage of my total income. It's not rocket science, yeah. And so my self-generated funds, I've just, you know, are things like donations and sale of goods, sponsorship, ticket sales, those sort of things. So if I go back and we'll just move on to some of the cash flow KPIs, because cash flow is obviously a big issue for many organizations. And the simplest of KPIs for cash flow is what's your bank balance? And it's not always the most useful, but certainly watching trends in that over time is important. Cash reserves in days is how much of your bank, if your revenue dried up today, how long would your cash reserves last you? And before the pandemic, this used to be a fairly theoretical question, which we would suggest to people, because mainly thinking that if you know you've got 90 days cash in reserve, if things dry up completely, we don't actually expect something to dry up completely, but if you just lost some funding, you know, If you lost half your funding suddenly, then you can probably last for 180 days, which gives you time to find other funding. Whereas we all know that a couple of years ago, with the advent of the pandemic, some organizations did lose their funding very suddenly, especially in the sports sector, arts sector. There was no income, full stop. And so having those cash reserves can make a difference between survival or not. Working capital is looking at your average debtors, your current liabilities compared to your current assets, and creditor days. How quickly are we paying our suppliers? So if we just have a quick look at some of those and see what sort of stories they can tell. So cash balance. In this case, I'm just looking at my bank balance for the last 12 months compared to the previous year. And, you know, maybe it is seasonal in some organizations. There are times when you've got very little money in the bank, times when you've got lots, you know, especially if you're grant funded and your grants come in every 3 months or 6 months, that may make a difference. Sports team, you might get all your memberships at the beginning of the season and then nothing for the rest of the year. So just looking at the trends in that bank balance can be useful. And cash reserves, in this case, this organization started off 5 years ago with, you know, 200 days, and they've managed to increase that gradually to 500 days, which is, you know, a year and a bit, which is, most people would say, is more than adequate. But then we never know what happens with the pandemic. And working capital is your total assets compared to your total your current assets compared to your current liabilities. And having a number under 1 is generally considered a risk of insolvency. So it's about making sure that those short-term loans that you might have, credit cards, those, you know, payroll liabilities, those sort of things are more than covered by your bank balance and your debtors, those sort of things. And then creditor days, how quickly are we paying our suppliers? Now, this organization is pretty slow at paying its suppliers generally, but I think the main thing that I would get from this chart is that it's started to blow out in the most recent months. So it's, again, it would cause me concern as a board member if I saw that. I would say, what's changed? Why aren't we able to pay our suppliers? And I think that comes back to, with these KPIs, it is a matter of what does it tell you as the viewer of these. So as I said, the formulas that I've used are all in the PDF attachment. I'm aware that we're getting close to time, so I better give you 5 minutes for questions. Eric, does anybody have any questions?
Yeah, Mick, so if anyone's got any, now's a good time to type them into the questions box to let us know.
That either means that that was all clear and simple, or I've totally confused them all. One or the other, yeah.
I think we've got someone here on standby. That's right. Thanks, Glenn. While I wait for people to keep typing, if they've got any last minute questions, I guess I'll just reiterate a couple of the points that we made at the start of the webinar. Mick, I know you've just made reference to that samples handout. If anyone hasn't managed to get that at this stage, don't worry, I'll be emailing it out to you. Again, this webinar was being recorded, so you're going to get a copy of the slide deck and the recording and another copy of that handbook. So yeah, if you haven't seen it all yet, don't worry. Yeah, you'll get a copy of that. That ought to be going out tomorrow morning or Monday morning. So keep an eye out for an email from myself on that one. Here we go. Glenn, got a question. Thanks, mate. So Glenn has just got Calxa, it sounds like, during the webinar, and he's asked how can he connect that to Xero when it comes through?
Okay, it's got nothing to do with KPIs, but that's all right. If when you sign up to Calxa, if I just go to the, have I got a website page here somewhere? If you're on the Calxa website and for example you start with the free trial, it will step you through connecting to Xero or MYOB or QuickBooks or whatever you're using. So first thing it'll ask you to do is just register your name and password, and then it will ask you to, it'll just ask you to sign in with your Xero credentials, choose which organization you're connecting. It'll pull the data through and then ask you some basic questions about the when you pay GST and that sort of thing, and then you'll be ready to go. If you get stuck along the way, little messenger app down the bottom here, you can send a message and tell the team you're stuck and they'll look after you. That's the way it should work anyway, Glenn. So let me know if it doesn't.
Excellent, thanks, Mick. All right, got a couple questions here. So Rowan has asked, we have 20 plus business units that need KPIs applied to each one, as each unit represents a separate funding stream and P&L. Any input on how to do this efficiently?
Yes, is my, so in Calxa, so I was showing just one business unit here, which is my support local, and I've got my non-financial metrics there, but I've got the same thing for my budgets, and I can do those metrics by any of my business units. So under overheads here, I can, I haven't got so many different metrics under overheads, but I can just choose the ones that I want to use there. And then when I'm reporting, if I do, if I do something like that KPI comparison report, where is it? I don't want the line chart. This one, for example, I can say I want to do this for all my active projects and choose my different KPIs. So I can do my, wages to turnover. I've got no idea what else I've got here. I know I've got the admin to revenue that we looked at earlier. So I can choose my different KPIs. I can sort them in, by the highest wages to turnover, and then have them all one after the other, showing. So in this case, I'm showing my different business units and each of those KPIs. So there's different, in Calxa, there's different ways of showing them. And I think this is where something like Calxa makes it a lot easier than doing it in a spreadsheet, because in a spreadsheet, you've got all that stuff disconnected. Whereas in something like Calxa, you've got one KPI formula, you've got a set of reports, and then each time you want to report, you just choose, I want this KPI, or I want this business unit, or this group of business units, and that sort of thing. So happy to engage in a conversation offline about more detail on that if you want to. I think somewhere on my slide, my email address should be there somewhere. No, it's not. Okay. It's mick@calxa.com. Eric knows where to find me, but you'll also find me through the Calxa website.
Thanks, Mick. And that's right. Yeah, if anyone has got any questions offline and you can't find Mick, just send us an email as well, and we can loop you two up as well. So don't worry about that. And Glenn, thanks for your question. And I can see your follow-up saying to say you've just seen the answer. So thanks for that. I think that about wraps it up. Mick, was there anything else that you wanted to say here at the end?
Oh, just thanks everybody for coming along. I hope you've got something useful out of it. Feedback's always welcome on these things, and we'll do them different next time. So thank you, everybody. Enjoy the rest of your day.
Brilliant. Thanks, Mick. Well, again, like I said, everyone, this webinar is being recorded, so keep an eye out for an email. If you've got any questions offline, touch base with us. We'll get in touch with Mick. Otherwise, I'll reiterate what he said as well, which is thanks for coming along. Thanks as well, Mick, for presenting. And yeah, enjoy the rest of your day, everybody. We'll catch you at the next webinar. Have a good one. Bye.
Bye.